Good morning, everyone. We will kick off the webinar in a few minutes as we give folks time to log in and get our panelists set up as well. Morning, Derek.
Morning. Can you hear me okay?
I can hear you. Can you hear me?
Yep.
All right, and then let me just get Justin up in here. Morning, Justin. Justin, can you hear us okay? Let's see. Okay. Got folks getting in here. Oh, excuse me. I think Justin, we're figuring out his audio. Justin, do you want to just say a few words so we can make sure we can hear you? There'll be a few more people logging in here, so I'll give them one more minute.
Can anybody hear me? It doesn't look like it's working.
We can hear you, Justin.
Okay.
And you can hear us? Did the audio work?
Okay, there we go. I think I have it working on my side now.
Okay, perfect. Yeah, we can hear you. Perfect. Okay. And looks like we still got a few more folks, but we'll go ahead and get started. Good morning, everyone. Welcome to our Income Lab webinar this month. We're excited to have everyone back, and to our new folks, welcome. My name is Malkley. I will MC today, and Justin and Derek will be our panelists. So generally, they'll go through their presentation, and then you'll see in the Zoom meeting here, we have a Q&A section set up. So after, as you have questions throughout the presentation, feel free to put your questions in that Q&A section, and keep an eye on the Q&A section as well. If someone has a question that you like, you can kind of vote it up and move it up in the queue. And so after the presentation, we'll then run through the Q&A and get all the questions answered. We will send a meeting recording after this as well, so you'll see that come out tomorrow. And if you would like to set up a meeting with our team to walk through a demo or just go deeper into the platform, please reach out to us via email or through our website, and we are more than happy to set that up for you. Perfect. And outside of that, Justin, Derek, sounds like we got audio working now, so I will turn it over to you guys.
All right. Thank you. Sorry for that, everybody. User error. So today we're going to, this series of webinars, we try to cover kind of general topics in retirement income research. And so today we have kind of a provocative title of the worst time to retire had a 7.5% withdrawal rate. So we're going to be talking about withdrawal rate research, withdrawal research in general. We'll weave in some of the themes that you've seen over the past few months as well regarding things like economic context and so on. So it should be a fun one. Okay. All right. So one reason we're doing this webinar is withdrawal rates are in the news, or maybe back in the news. Maybe they never left. I'm not sure. It's definitely a popular thing for journalists and researchers to write about. I think that this last round of headlines was kind of sparked by this new report from Morningstar from last year. It's actually, it's quite a rich report. It's very long, but of course, kind of the headlines of it were that now the safe withdrawal rate for retirees is 3.3%, not 4%. In fact, I wrote a little something as well that appeared in Financial Planning. You'll see the URL at the bottom there, covers some of what we're covering today as well. But before we talk about retirement withdrawal research, I want to cover kind of a caveat here, which is that this sort of research is really useful for teaching us kind of how to think about certain issues in retirement, but it's really not useful for developing a particular plan for a particular household. That's because things like what Derek and I have called the retirement hatchet, which you see at the bottom here, and differences in longevity expectations, fees, investment approaches, assumptions, all sorts of things, they don't have the form that this research usually assumes that a household would have. And that's not a problem with the research. The research needs to assume something, but it's just important to understand that it's not meant to match up to a particular household. So just to give an example, the retirement hatchet here, you see that kind of the dark blue is the portfolio withdrawals for this household. And because they're deferring Social Security for, looks like 4 or 5 years, they're going to have substantially more withdrawals early on than they will once Social Security starts. So in this case, probably far more than 3.3% or 4% of their portfolio would be coming out. That's not necessarily a problem just because it doesn't match with this kind of rule of thumb research. The problem is trying to apply rules of thumbs to particular situations. That being said, what usually people do in withdrawal rate research is use an extremely simplified household situation, again, to try to discover some things, some ways to think about funding retirement income from an investment portfolio. So, this research really began, or at least, kind of took the imagination in the early to mid 90s with Bill Bengen's research and the Trinity study. And usually what we're dealing with there was a 30-year retirement funded entirely from an investment portfolio where the withdrawals are, some amount, usually that's expressed as a rate of withdrawal. So the amount based on the initial portfolio, and then those are adjusted for inflation going forward. There could be different inflation assumptions, sometimes could be based on historical inflation. Sometimes you'll see just an assumed 3% rate, but that's kind of the core of this simplified picture that's then used to try to extract some knowledge about the world. So what we have here is a historical picture of exactly that, a 30-year inflation adjusted initial withdrawal rate. This is from a 60-40 stock bond portfolio. In the research, you'll certainly see people play with the asset allocations. And I've pointed out in kind of the brighter colors, the periods when these withdrawal rates, these sustainable withdrawals, were below 5%. So we kind of have 4 main areas, 2 fairly short and 2 fairly long. So pre-World War II, or kind of through World War II, and then we have a brief period right before the crash of 1929, and then another period in kind of the late Great Depression. And the biggest and most relevant period to us is what I've called the lost decade, basically the 60s and early 70s. And the reason that's most relevant to us is this is also the historical period that gave us the 4% rule. So there's a period, as you can see, in kind of 65, 66 that hits the gray line here. And that is the minimum in this kind of research, the lowest withdrawal rate ever, right? So it makes it appear that, well, that must have been the worst time to retire, right? Because here's the same in a larger zoom, and you can see right there, 65, 66 is where we're hitting the gray line. We almost hit it back in the Gilded Age, but that's a little harder to connect with for today's retirees. Of course, the problem with this is we spend dollars, not percentages. And so although this is interesting information, it's useful, I'm certainly not saying we should ignore withdrawal rates or withdrawal rate research. It's just part of the picture. In order to explore another part of the picture, I want to look at this sort of save then spend life cycle. Now, this is not what people actually did in the Gilded Age or in the, but we're going to pretend that historically people saved money over time into something like a 401k, and then spent their accumulated nest egg over their retirement. Again, super simplified. There's no Social Security in this picture. There's, again, we're assuming that people had access to these sorts of things. So what we have is a 40-year accumulation period, saving $1,000 a month adjusted for inflation, followed by a 30-year decumulation period with flat inflation adjusted withdrawals. My guess is no one in the history of humanity has ever done this, but it's a good kind of model to play around with. So what happens when we look at the world, the history in this way? We see that if we measure the sustainable income in dollars instead of percentages, that November 1965 happens to be the absolute low in that particular study. Yes, indeed, had a 4% withdrawal rate, but an annual real income, so adjusted for inflation, of $86,000 in today's dollars, which is at the 45th percentile of everything in this study. So here we have retirement dates from 1911 through 1992, so 30 years ago. And so roughly average. It turns out that the 60s were a time that could have sustained, let's say, a standard of living that's roughly average. Not the worst time to retire, but the average time to retire. There are two periods that I've pointed out here. One is kind of pre-Great Depression, where the minimum of that red section here is in 1918. And I figured I'd point out a minimum from that more recent period. So the minimum we find from the more recent period of the lost decade, it's actually a little after that, is 1974, when we would have had an inflation-adjusted income of $62,000. So the worst time ever in this picture of kind of the 40 years of accumulation and then the 30 years of decumulation is $52,000. And the withdrawal rate at that point that you could have had with full foresight was 7.5%. So thus the title of this webinar. So what's going on here? Why do we see such a different picture? The main reason is pre-retirement sequence of returns, right? So because we are having our hypothetical savers save over time, $1,000 a month, slowly accumulating this nest egg, the sequence of returns before retirement has a huge effect because it will determine the size of your nest egg when you do retire. And here are inflation-adjusted nest egg sizes given that 40-year savings behavior. And the red ones are the nest eggs that are below $1.2 million. And so again, we see here that there are these two periods. There is a third kind of in the Great Depression again, but sort of this pre-Great Depression, and then in this case, mid 70s to mid 80s period that were particularly tough on nest eggs, right? So where if you had been a saver in this way, investing, it would have been, you would have found yourself, with not as big of a nest egg as through the rest of history. Crucially, when we also show withdrawal rates, so we combine basically that chart with the first chart that we saw, which is maybe the more familiar one from Bill Bengen's research and the Trinity studies, we get this kind of beautiful butterfly picture, right? Where there's an obvious inverse correlation between these two things, the size of your nest egg and the withdrawal rate that we know could have been sustained from that portfolio. The correlation here is about negative 0.8. So that's quite a, well, I guess low correlation, but it's high in the sense of it's quite an effect, right? And so what this means is it's actually possible to find the same income, the same standard of living that could have been sustained historically with totally different recipes. So a low balance at retirement with a high withdrawal rate can produce potentially the same income as a high balance at retirement with a low withdrawal rate. So we've picked out a couple of pairs here, February 1921 and March 1916, which are marked with the red lines to the left. We can see they both produce the same income, but with very different sets of nest egg and available withdrawal rate. And then November of 1985 and March of 1961 are producing almost twice that income level, but again, with very different sets of nest egg and withdrawal rate. It's really remarkable here to see how focusing only on withdrawal rate misses a huge part of the retirement picture, because we're thinking only about percentages instead of thinking about standard of living. The issue, though, that I'm sure many of you are thinking of is, okay, well, this is great. This is all research that knows exactly what's going to happen after these points in time, right? Because we're dealing with history. And that's great. But in February of 1921, assuming the world were more like it is today, would anyone have felt comfortable recommending to a client that they take an 11.4% withdrawal rate? Or in November of 1985, would anyone have felt comfortable recommending to a client that they take a 9.1% withdrawal rate? Those seem high, right? And so potentially very risky. And I'd say it's a really good question. And this is the problem with looking at these kind of perfect withdrawal rates, right? Solving for exactly, we know what you could have had, is that when we try to apply them in practice, when we don't know the future, it can feel like we're at a little bit of a loss. Well, what do we do? It's fine to know what I would have done in the past, Monday morning quarterbacking, but what do I do when I'm providing advice right now? And I think one of the keys to answering this question is, putting yourself back at these periods in time. So the most recent one that had a really high withdrawal rate, and this is a chart from Income Lab in the historical analysis section, just kind of just an example household, nothing special going on here, but you'll see some peaks in the early 90s, early 80s, early to mid 80s. And the question is, well, what could we have done at this point? We know in retrospect that a household could have afforded quite a high withdrawal rate. Again, we saw that actually their nest egg would have been fairly low, but we might not have felt comfortable recommending a high withdrawal rate because we didn't yet know the future. So what can we do? we can sort of judge ourselves only in retrospect, right? Did we get our clients the standard of living that they actually could have afforded? We'll know in retrospect what they could have afforded, but at that time we won't. So the answer to this is we need to be ready for adjustments. So it's, I think, totally reasonable and rational not to recommend an 11% withdrawal rate, and to recommend something a little bit lower, and then just be ready to adjust, right? So as the future plays itself out, or if we go back to 1982, for example, imagine you retired with or this is 1986, sorry. You retired with a relatively low withdrawal rate. I mean, 4.3% is very low historically, in terms of what was available at different points. So even if you had begun very low, as long as you had a plan in place that was going to tap you on the shoulder and let you know that, hey, life is playing out here and it is giving us messages that we started too low. As long as you have that in place, you can rapidly increase the income level in order to capture some of that standard of living that the actual experience the household is having is offering to that household. What you give up here is the income at the earliest periods, right? And so that's the cost. The cost of being cautious is that they may have to wait to have a higher income level. The benefit would be, well, if we're wrong, we don't want to be wrong on the 11%. Maybe we can start at, I mean, this is quite low, 4.3%. But you'll see over time, we add 50%, 100%, 160% to their purchasing power. And for those of you who followed some of the work on total risk guardrails and things like that, these increases of income they're not increasing risk. In fact, all they're doing is returning you to the same risk you began retirement with. So what's happening as you're increasing income is your plan is saying, hey, we started with a nice big risk buffer, which recognizes that a lot of people are risk averse. But if that buffer gets too big, we're really, we need to adjust, right? So we can start with a risk buffer, but if the risk buffer grows, let's just reset the risk buffer, right? Let's not get too far off. And so that's what's happening here. So 1986 is a great example of something that originally we know from history now that they could have started with a high withdrawal rate. But if they hadn't, you still could have provided them with a very high income over time if you've been ready to adjust. So that's the end of kind of the slides, but I think usually what we do here is kind of open it up to Derek if there's any kind of points on practice or just on the topic in general, and then we'll take some questions.
Yeah, I mean, I think for me, just the ability to actually have these conversations around what happened in the past is a really big deal. That's something that I think it makes all this abstract planning just so much more tangible when at least you can talk to somebody about what's happened in the past, these different time periods, what somebody could have spent going through there. That to me is it really takes that really abstract, hard to grasp kind of concept and at least puts it in a context people can understand. Now, of course, we know the future could be very different than the past, but at least that gives somebody something that might give some peace of mind and comfort when they think, okay, yeah, we've seen markets go through some tough times. It's not like it was all great in the past, but just having that context I found is big. But yeah, with that, I think good to jump into questions.
Yeah, one thing I thought I'd point out, I realized I missed while we're queuing up questions, Mackley, is if you are wondering, you just saw a bunch of historical examples, pairs of time periods that could have produced different kinds of income and so on. Where are we today, right? So sort of what can we learn from this? What you will see here is the nest egg for this, again, nobody saves $1,000 a month from age 25 to 65 exactly, right? But if they had, they would be at a relatively high nest egg compared to history, right? And so, although I just kind of belabored the point of, hey, even those periods where you had really high withdrawals, you eventually could get there by adjusting. In fact, today it looks like we're in kind of the opposite position, right? So we have high nest eggs, which usually pair with, relatively low withdrawal rates.
Okay. Thanks, guys. I do see a few questions coming in to our viewers. If you find the Q&A section, you can see the questions that other people have asked, and you can like and kind of move those up in the queue or start adding your own questions as well. But I will start from the top here. So first question is, so these withdrawal rates in the research are telling us how much someone could have withdrawn annually if they retired in that specific year, correct?
That's right. So now this is just nest eggs, and we're able to go through today because we're only looking at nest eggs. But if I pair it with the withdrawal rates, then the most recent withdrawal rate I know is 30 years ago because I'm using a 30-year retirement. And so, yes, this is the dates along the bottom are the date of retirement. And so the 40 years of savings would have been before that date. The 30 years of retirement would be after that date.
And then next question is, do you have insights about stock market valuation measures and withdrawal rates?
Yeah, so actually last month we did a webinar on economic context and what it can teach us about or the ways that it can be used in retirement income planning, or even just retirement income conversation and communication. And we're actually working on some blog articles as well, covering more ground in terms of economic context. But it's not nearly as good of a correlation as what you see here. But there's definitely something to be gained from measures like CAPE. And actually what'll be in this research is that especially CAPE measured over longer periods of time. So typical CAPE is a 10-year CAPE, but even if you go a little longer, you get even better information for retirees. The reason is, retirement is a really long-term process, right? And so we can kind of get information from that is useful for long-term decisions, which is harder to get for short-term decisions like whether to buy or sell a stock, right? So that's sometimes people can get a little uncomfortable with, okay, well, is this some kind of market timing or something? And gee, there seems to be a lot of research that market timing is tough, if not impossible. Looking at economics for retirement income planning is a little bit different there because it is such a long-term effect.
And next question is, will you revisit the notion that nest eggs and withdrawal rates are almost perfectly negatively correlated?
Yeah, I mean, you don't see these sorts of things just naturally occurring in nature very often, right? It's a really low correlation, I guess, in this case, but almost perfectly negatively correlated. Yeah, I mean, it's in a way what we're seeing here is just market cycles, right? So if you've had really good returns, you're going to have a high nest egg. If you've had really good returns, more and more historically, you're getting closer and closer to worse returns in terms of sequence of returns, right? So we tend to see good returns followed by bad returns, followed by good returns, followed by bad returns. And that's really what this is showing. So I take it as very encouraging that really, at least historically, if you've had the benefit of a high nest egg, you get the benefit of the high nest egg. Maybe you don't also get the benefit of a really high withdrawal rate, but nothing's perfect. On the other hand, if you happen to be in one of these periods where you've had really poor pre-retirement performance, I think we can be justified in expecting things not to be the worst ever then going forward, right? So because of the cyclical nature of returns, I think that's what we're seeing here. That's the explanation for this chart.
And one other kind of comment related to that, I think for me, I'm not a fan at all of kind of the nest egg targeting, that people sometimes do going into retirement. And this is often one way that I'm using Income Lab to kind of reframe some of those conversations as the client says, I want $1 million in my my IRA by whatever date, retirement date. And to me, that's just, I don't necessarily go in this level of depth with the client, but this is a reason why nest egg targeting really isn't better. And I try to move the conversation to, let's talk about the guardrails. Let's talk about how much you can spend. Let's think about, and just in terms of dollar amount of income that you can generate, instead of trying to target a portfolio amount just because of this general relationship, and why nest egg targeting just really doesn't work. And then, of course, having a tool that takes that economic context into consideration helps inform the guardrails in an even better way. And so that, to me, just to get practical about it, like that's the real takeaway here is that, for me, being able to shift the conversation from the nest egg to just the income level, which will be a little bit more stable because of this. And then also, just reframing that client expectation and having that conversation.
That's I hadn't thought of it that way, Derek. I know this presentation seems to say, hey, maybe we pay a little too much attention to withdrawal rates. Withdrawal rates are just part of the picture. If we had a focus on nest egg, we could say the same thing, right? I mean, so maybe we focus too much on nest eggs, right? If they're not the whole picture. Like if you look at the jaggedness of this, right, which is nest egg, it looks really volatile, right? You can have all sorts of different experiences. Compare it to this, which is, the standard of living with this simplified picture. You can see it's incredibly smooth compared to both the withdrawal rate and the nest egg pictures.
Okay. And next question is, what about those clients who have little spending flexibility based on fixed costs, whether that's real or perceived? There's a tension between spending to enjoy early years while health is usually better, and it's often more difficult to cut spending later when there's less discretionary spending. Kind of what are your thoughts on that?
Yeah, I mean, my thought is that's the crux of it. That's the hard conversation, and it's probably a little bit more of an art than a science. But Derek, you probably have more.
Yeah, I was just going to say that, I mean, that's always a challenge. It's good to identify what that real floor is, and you can build a floor into the plan and say that spending is not going to go below a certain level. Just anytime you put a floor in, now you're introducing the risk that you actually do deplete the portfolio. But at the same time, that's I know I think it's Finca and Blanchett. I might forget the third author. I think there's a third author on the paper, but they have a paper from a while back where they were looking at how we actually the whole 4% rule is just based off of not depleting a portfolio, but when people have some sort of backstop, they have some Social Security, pension, other type of income, it's reasonable that they'd be willing to actually take some risk of depleting a portfolio. And then that alone moved the kind of range from 4% up to I think it was even 5 to 8% based on somebody's risk aversion as a starting distribution rate. So, thinking about that, yes, there's no mathematical answer I don't think that you can give in terms of what's the optimal thing to do, but you're always trading that off and you're thinking about where do we want to set that floor? What is the client's true floor? And understanding that, and then proceeding accordingly. And if somebody really doesn't want to take that risk that their floor could ever be depleted, then maybe it's not even an investment portfolio. Maybe it's more of an annuity product or something else. But then you have a risk of inflation and everything else. But yeah, I think Justin's right. It's more of an art than a science.
It's a good point, though. So all of this entire presentation has just been portfolio withdrawals. And when you bring non-portfolio, whether it's Social Security is most typical, right? Starting to think about, okay, how do those decisions affect my kind of dependable floor? I mean, now things like deferring Social Security, there's an extra benefit there, right? Because that inflation adjusted non-portfolio income is incredibly powerful in producing, better experiences.
And next question here is, I've seen evidence that an 80-20 mix is better than a 60-40 mix. Are there any major differences if we use that allocation?
I I did not run these with an 80-20. It wouldn't be hard. I suspect you would see a little bit more volatility, but otherwise the same shape. So just, a little bit different between the peaks and the valleys. But if we could take your name down, we can always shoot you over some charts.
Yeah, and I might just add to that. I think it's always tough too to, what do you mean by better, right? What's the objective that you're going for? And particularly somebody that's prioritizing legacy type balances, I think that'd be very true that historically an 80-20 probably, yes, you're introducing more risk of depleting the portfolio, but the remaining portfolio balances will be substantially larger. And then you get into the whole discussion of you can actually vary the allocation over time. And I do think there's really something to, like Michael Kitsis's the rising equity glide path, and that's been something that really for somebody who's 85 at this point, oftentimes they could be take on about as much stock risk as they personally wanted to, because once they made it through that initial period and got through the phase where sequence of returns risk was the highest, at that point there's just so much upside for the typical retiree that it's all sorts of different ways you can go about it, but you have to figure out what you mean by best, because however you define best, then that's going to impact the actual portfolio allocation decision as well.
I think this next question is kind of touching upon the Social Security comment you made, Justin. But what's the impact of FERS and other pensions on the withdrawal rate decision?
So I'm not familiar with FERS. It sounds
I'm
like
not even.
federal.
It's the federal employee retirement system.
Yeah. So is that inflation adjusted?
I don't deal a lot with FERS. I believe they do get an inflation adjustment. I'm just not sure if it's as robust as Social Security. I defer to somebody that actually deals with FERS clients more on that. But yeah, there is some adjustment to it.
Yeah, I mean, I think maybe that was a little cryptic when I said, inflation adjusted lifetime income like Social Security is incredibly powerful. Maybe I can add a little bit of meat to that. So in fact, you can just go onto Income Lab and add a pension that's inflation adjusted. And if you're also using the retirement smile, for example, which recognizes that people tend to want to spend more when they're young and active and less as they age, you can add more than $1 of current spending with every new dollar of inflation adjusted future income. Because of the smile, right? And that's one way in which this is incredibly powerful. So yeah, when we complicate the picture, or maybe the better way to say it is when we make the picture more realistic, there are more tools that we have available than just altering the portfolio and things like that, and decisions on whether to defer, or I don't know all the options with FERS, but if there are survivorship options and things like that would start to become very relevant. Yeah.
And
thank you, Robert, for sharing that link there. And it looks like I'm reading quickly again, and I'm not a FERS expert by any means, but it is that whole weird thing with FERS where under 2% you get the CPIW, 2 to 3% you only get 2%, and then more than 3% you get CPIW -1. I think that's correct. But that's going to be extra difficult to model the impact. But just generally speaking, thinking about the principle of it, yes, certainly incorporating that the inflation adjusted income into the plan is going to have a big difference in terms of what retirement outcomes somebody experiences, and oftentimes I've found the results look really good, for Social Security in particular. That's what I deal with more, but that really delaying Social Security makes a lot of sense. The thing that I think is underappreciated about that is you are actually kind of front loading, going back to that hatchet, right? You're front loading the distributions. When you do that, you're introducing maybe a little bit more sequence of returns risk. But I've always approached that with clients as saying, well, let's say, we do encounter a bad market when we're in the blade of the hatchet there in the high distribution years. If things get so bad that we feel like we shouldn't continue down that path, you can always turn Social Security on. So that's certain pensions may not have all that flexibility, but that is one way that I'm addressing that conversation with the clients. Is this makes a lot of sense. If the market absolutely craters, maybe then it's something we should revisit and reconsider, and at least we can always opt to turn Social Security on earlier.
And then next question here is, have you considered results from other economies' economic history? U.S. capital markets have generally outperformed in modern economic history.
Yeah, so I know Wade Pfau has a good article. It's probably, I don't know, 15 years old by now, but it's really good, where he basically redoes this withdrawal rate research with other return sequences. And as you say, finds that there are certainly countries where the withdrawal rates would not have been nearly as high. So the minimum withdrawal rates could have been extremely low in some economies. And yeah, that's the other big caveat with really any historical research, is just understanding that the future could be worse than the past. That being said, it's also important to remember that historical data is the only data we have, and so it's often been a reasonable thing to take into account. So it's not that we know nothing. And I would say my own preference is that dealing with the fact that the future could be worse than the past by having plans for change is a good way to go, as opposed to assuming things will be really awful and beginning life that way, or beginning retirement that way.
And this next one's maybe more of a comment, but maybe another webinar we can do. But it just said this advisor would be interested to see the opposite scenario, starting to a high at a bad time.
So if we look at this, oh, you're talking about, right, a time where, so I gave the example of if you had retired in this area in the mid 80s, it would have been tough to just take a leap of faith and start really high, but hey, you could have adjusted. So you're saying, well, what if you were in the 60s and you had started with a high withdrawal anyway? What would have happened? Yeah, we actually have, I think there are some pieces that we have on our website that do go over a 1960s example. I mean, it doesn't start super high, but you still do have to have some adjustments down. I think even if you started at 4.5%, 5%, you do, I think it's 3 adjustments. 2 of them are just less than full inflation adjustments. One is an actual reduction in your income in order to kind of keep the plan on track. But yeah, so plans that start even higher than that will be have a little rougher road, but we do have, a reasonable example that addresses that on our website.
And then next question is, what does the high inflation rates of the last decade say about today's plans for withdrawal rates?
Yeah, this is interesting. And actually, I think did that piece just come out, Markley? I think on Advisor Perspectives, maybe we could drop that link in the
chat.
So I just published a short article on inflation about exactly this. So the last decade, let me get back to the withdrawal rate right here. So what's interesting is we had sideways stock markets and high inflation, which the 2 of those things together are what produce bad, prolonged low real returns. That's really the worst environment for a retirement income that is funded by investments. But it is interesting if you look at the timing. So really the high inflation didn't start until into the 70s. I would have to look at the chart again, but I think decently into the 70s, 72, 73, something like that. And yet your withdrawals in retrospect would have been quite low in the 60s. So, and then if you look at withdrawals that would have been possible, later in that high inflation period, they're quite high, right? So unfortunately, high inflation is a little bit of a lagging indicator, or maybe not even a little. It is a lagging indicator on on retirement experiences. So they're not particular, it's not, we would love to have it be a leading indicator to help us make decisions, but it's not. So inflation was pretty low in the 60s. So it's hard to kind of see it as a great trigger for decisions. The other thing is that it really has to be prolonged. So short periods, a year or two, 3 even, there's been very little to no correlation between that and how much income you could have had in retirement. There are periods with extremely high income and short bouts of high inflation. So that's not very helpful, I know, but really it's well, it will depend on how long this high inflation period is to see whether it affects retirees. And if it does, it will affect the retirees who retired several years ago. And so it may be a little bit, it's not something that they could have accounted for at the time when they launched their retirement.
And Justin, what was the name of that article on the website around the research in the 60s?
I think the one on it's actually the PDF, I forget what it's called, but something about the value of
the ebook value of ongoing management, I think.
Yeah.
Okay, perfect. I will post that one. I posted your Think Advisor article in the chat as well, so I'll get that one and post it in the chat while I work on get you guys on this next question. So next question here is for those retiring or accessing tax deferred accounts after 72 and who defer Social Security until 70, what are your thoughts on defaulting to IRS mandated RMD percentages as a baseline to maximum? Derek, maybe if you have any.
What was the last part of that question?
So what are your thoughts on defaulting to IRS mandated RMD percentages as a baseline to maximum?
Gosh. So is that saying that basically that becomes a cap on spending, or? I'm not totally clear on the question, but I would say
meaning either baseline or cap.
Okay. Yep. So, I mean, that's gonna, if you do treat the RMDs as a cap, I mean, that's going to be a very, I think, conservative spending level is where you'd ultimately end up at. And I think Blanchett recently has done some writing kind of around how, maybe it was Blanchett and Finca, but about how you can use RMDs as actually kind of a strategy on their own for controlling, putting in a dynamic spending policy. I don't think it's, the best because, if you're relying just on RMDs, you're really getting isolated and focused just on the IRA portion of the portfolio. You're not accounting for what taxable assets are there, what Roth assets are there, what's the guaranteed income sources, what's all that bigger picture, because it might mean that particularly for somebody with a healthy amount in Roth accounts, you're probably, it might make sense to deplete.
Did we lose Derek, or is that just my Wi-Fi?
I think we may have lost him.
We may have lost Derek. Okay. We'll give him a few seconds to get back.
Maybe we can move on to another. Oh, there he is.
Are you back, Derek? We lost you for about
30 seconds, maybe.
30 seconds? Oh, well, I guess I'll try to, I was just saying, I like using that target income level that takes into account everything, because maybe you actually do want to deplete the IRA. If you have, say, a lot of Roth assets, it might be a perfectly reasonable thing to do. But if you treat the RMD as a cap, that is a very conservative strategy in the sense that it will at least preserve IRA assets, because you're just never going to spend everything that way.
And then next question here is, can you speak to how Income Lab uses economic context?
Yeah, so we have a picture of economic context that we build every month. So we're tracking, and this, if you want some more details on this, I think the recording of last month's webinar is available, and we'll probably revisit that topic again because it sounds like it's of interest. And we just build a view that says, let's measure how far away from today's situation every point in the past was, and just rank them. And so it's things like inflation, although we use longer term inflation to try to get at least some some useful, 1 month of inflation is, as I said, basically not useful. A market valuation measure, we use unemployment. There's several other things that you'll see in that. And then when you are looking at the historical analysis chart, which is an example of which is right here, you'll see you're able to change the shading here. So the shading you see here is show me in blue the 1/3 of history that is most like today, right? So you're able to say, well, to the extent that I can use this historical context to understand today, well, gee, it happens to pick out the periods that are, it's kind of excluding some of these peaks, other than the 1870s, but most of the time it's pretty tough to connect with that environment, right? So just to be clear, there is nothing in the software that said, hey, exclude the peaks. That was not part of this. It just happens to be the periods that are more like today along those measures we know could have produced lower withdrawal rates. And so that's one way that we use it. If you're using historical analysis, you can actually apply that when you are proposing income. So what it tends to do is really just tilt your income. So it's not making a major bet. It would be very difficult to get the system to choose an income level that's at the peak here. But in times of relatively higher retirement risk, your proposed income will be slightly lower. In periods of relatively lower retirement risk, your proposed income would be slightly higher because of this effect.
And we have about 5 more questions left, so try and get through these. But in your Monte Carlo simulations, how do you model the auto correlation in annual returns?
I mean, there's no explicit modeling of autocorrelation in this. It's a random walk, kind of picking from the distribution. So I don't know, Derek, I know you've done a lot of Monte Carlo work. Do you have comments there?
I mean, it's a topic that's always intriguing and interesting to me, but yeah, it's not something that's done within Income Lab. I do think for practical purposes, relying on like the regime-based Monte Carlo, where at least we can use some kind of different forward-looking 10-year to assumptions and then let things drift longer term. I think that's useful and practical. It's I've never even seen. I know it's talked about in research, and I'm sure somebody out there's probably done something with it. But I've been looking for a little bit more on that topic myself.
Next question here, more kind of specifically to the platform. On the lifetime experience, when scenarios are below plan, is this after taking into account inflation adjustments? For example, if they start out taking 10K, if 20% of the scenarios are below plan, does that mean they are below 10,000 or below 10K adjusted for inflation?
It's all adjusted for inflation. So yeah, we're not giving you credit in the 70s for having really high nominal income, even though maybe your purchasing power was lower. Unfortunately, those scores would look much better if we did. But yeah, it's always compared to the original plan you had, which just to go back to it seems like I'm going back and forth between these two charts a lot, but it's basically saying, okay, well, if this was your plan in inflation constant dollars, how did things work out compared to this? Are you above or below it in inflation adjusted dollars?
Next question here is, would a reverse mortgage line of credit be a way to mitigate the issue of spending inflexibility? Example, the inability to cut spending later.
Wade Pfau's done a lot of good work on that topic, and I think definitely it's probably an underutilized tool currently in that from that perspective. I don't know if Justin had anything else.
No, that's exactly what I was going to say. I think, does he call them like buffer assets or something? Actually, your comment about Social Security made me think about that too, right? Whenever you have the flexibility to call in a buffer asset, if things really are, turning out worse than expected, like your point about, well, maybe you planned to defer Social Security, but you take it a little earlier. Anything you tap into like that Seems like a good bit of flexibility.
Mhm.
And then 2 more questions. Derek, I'll do this one first because this is specifically for you. So earlier in the webinar, you mentioned the client having the option to start Social Security income if negative returns or they encounter bad luck early in retirement during high withdrawals. This advisor said, I think about this and deal with this regularly. Do you consider more conservative equity bond or asset allocations during the blade of the hatchet time? I don't have a good answer, but it's on my mind a lot these days.
One thing I've actually started doing, I like buckets from a psychological framing tool, and Michael Kitces has talked about using them that way. And so I do like to look at, what's the income that we would need to get through the blade, basically. And that's something I've been talking to clients more and more about because, sometimes it would be too conservative of a portfolio, in my opinion, to fully fund it. But let's say somebody's coming to me, they're 67, they're only deferring 3 more years. Fully funding that blade, in a kind of protection bucket or however you want to frame that, might actually only be 30 or 40% of the portfolio. And definitely that's something I'm going to be talking to them about in terms of, well, yes, we are actually, not only could we turn Social Security on earlier if we had to, but here's what we need, to kind of fully fund so that you can get to Social Security without having to pull from your stocks, and a very reasonable allocation towards fixed income cash could cover that. So that is something that I'm talking to clients about, and I think it makes a lot of sense to me.
Thanks, Derek. And this last question, more of a thought than a question, so I'll just read it and see if you guys have any final remarks after this. So just a thought, it's clear to me that clients should be presented with potential results of their decisions before selecting specific goals. Derek's careful answers focusing on goals and risk aversion got me thinking about this in terms of clients not really knowing what they don't know about retirement income versus legacy desires.
Yeah.
Yeah.
I think it's a good point that certainly clients may not know. I think a lot of times, if you're showing information like is available within Income Lab to a client, you're probably the first person who's ever showed them that, first person having a conversation with them about that. And so, yeah, it absolutely, the client probably doesn't know. They can't give you a clear answer.
I think we lost Derek again. Justin, any last?
Probably we would say the same thing. Yeah, I mean, asking for, having a good system for helping clients figure out goals, figuring out lifestyle goals and legacy goals and things, right? Rather than kind of, hey, fantasize about it. It's definitely better to provide them context and things, right? I mean, there are, if you just say, hey, what do you want? Well, we can build a plan that'll get you there, 0.5% of the time, right? But like what Income Lab really tries to do is provide you a way to provide context around, what are reasonable expectations for lifestyle and legacy. Often we actually find that it's very good news for clients. So it's not that this is, we're going to have to talk people down off of huge goals, but I definitely agree with the sentiment.
Well, guys, that is it on the questions. Again, thank you both so much for the time and effort you put into bringing cool topics for webinars and really helping our advisors and advisors new to Income Lab to really kind of just grow their knowledge on dynamic retirement income planning. For our users and attendees, I will send out the webinar recording tomorrow. But if you would like to set up a meeting with our team to look more into the software, maybe get some more questions answered, feel free to reach out to us through our website, and we are more than happy to set up a time and be on the lookout for the invites for next month's webinar as well. Alrighty. Well, guys, thank you so much. I will close it out for now, and we will see you all on the next one.
Thanks, everybody.
Thanks, everyone.